Hello, good evening and welcome everybody to my weekly webinar on technical analysis and trading techniques. This one is on the news trap trading strategy, one of my own proprietary trading strategies, which is used to capture moves based upon market traps. So what are market traps? That is the question. Well, market traps tend to form after a false breakout of some kind. So the theory is that many of the big moves in the markets that we would like to capitalize upon often form after the formation of a market trap. So market traps are formed when traders are caught on the wrong side of the market. Most of the time, traps will form due to a technical move, for example, the break of a support level or the break above a resistance level, but often they have a fundamental or news-driven trigger, so a news trap situation. So the trap forms in a two-step process. It's what I call break and retrace. First of all, we get the break, and then we get the retrace, and once that two-step pattern has occurred, then the trap is said to be in place, and then we're looking for a significant move. So the break occurs when the market makes a significant move. So as I mentioned, for example, a chart point breakout or a piece of news comes into the market. Significant moves involve stop orders being triggered as panic buying or selling occurs. So the market has been shocked by a piece of news. If the break move is reversed, then a trap is said to have formed. So we have the break and the retrace. So break, retrace, and then let's watch this space. This is essentially how the buy setup looks like on the break and retrace. So what we have in the case of a news item is the market starts off just before the piece of news hits the market, the event hits the market, and then suddenly the bearish event causes people to sell the market in a kind of knee-jerk panic reaction way. So the market sees this sharp decline following a piece of news. So oftentimes, most of the time, after this kind of knee-jerk reaction, the market will see a bit of a reaction, and then it will continue in its direction. In other words, the direction of the break following the piece of news. But what we're looking for is a situation where we have the break, a big move down, news-related, and then all of the move from the origin, just the point just before when the news came out, that all gets completely retraced. So once we've seen a complete retracement of this move from the origin to the bottom of the break, all the way back up again, then a trap has formed. So we have a bullish setup based on sellers basically finding themselves on the wrong side of the market. So once the trap has formed, we're expecting a big move to the upside after this break and retrace to the downside. Okay, so the news trap forms by a piece of news coming in which surprises the market. So we have a situation every day, pieces of news hit the market, scheduled economic releases, for example, and sometimes some unscheduled news hits the market. And if the market is surprised by the news, we get a reaction to the news by traders selling off and reacting to the new reality. And that forms the break of the break and retrace movement. Now, as I say, if the news-related break to the downside fails to see follow-through selling, in this case, those who sold the market will start to exit their losing positions. They get a bit impatient. And then we start to see a bit of a retracement against the move lower. So once all of the break move has been completely retraced, then the trap has formed, and then we're expecting a big move in the opposite direction to that of the break, in other words, to the upside. So before I move on, the same thing applies to the downside as well. So whatever works on the upside should work on the downside. So if we get a trap situation by the market breaking higher on a piece of news, the move being retraced, then we have a sell situation based on break and retrace market trap. Okay, so breaking news moves down into two categories. We have two types of release, or two types of news move. We have the scheduled pieces of news, And these are economic releases such as non-farm payrolls, which we're going to get tomorrow, interest rate decisions by central banks, retail sales figures, consumer price figures, survey data, anything that is going to come out of a body, a government body, or a government-related body, which can have an effect or shed some kind of light on the economy. And when the data comes out, then the market reacts to the data. We also have unscheduled news which can hit the market, cause the market to move sharply. And these are announcements by leading political or monetary officials, maybe some currency intervention that we didn't know that was going to happen. For example, we had on the Swiss franc a few years ago, or a political development, something happens which affects the geopolitical landscape. So these are news events that can suddenly cause buying or selling when they hit the market. So just to show you what the scheduled news looks like on a daily basis, every broker will give you an economic calendar, and this shows you upcoming economic events, economic data for the day ahead. Also shows you things like speeches by major policymakers. So what we have here is the CFI calendar, economic calendar on a given day last summer. You can see by country which country is releasing the data. What is the data called? Consumer Conference is coming out of Spain, Spanish flag there. We have a whole slew of data coming out of Canada and the US. This is actually done on non-farm payroll day back then. So what we have is, in the run-up to the data being released, what we have are a consensus building up amongst all of the players in the market, all of the banks and hedge funds. So a survey is undertaken and a consensus forecast builds. So as an example, on the non-farm payroll, what we have over the course of the month is we have the survey come out, and a whole bunch of economic gurus put their forecast for the non-farm payroll number, and an average consensus develops. So the important thing is obviously is when the number actually does come out and we get the actual figure, if the number deviates significantly from the forecast, that's when we get that potential for the knee-jerk reaction. And we may well see something like that tomorrow in the financial markets. So what we're looking for is that deviation from the consensus forecast, which causes a knee-jerk reaction to sell or to buy a given market. And once we get that situation, then we are ready to trade based on a news trap situation. Okay, so let's see a few examples of the news trap pattern trading setup in action. So I'll be using non-farm payrolls for quite a few of these examples, by the way, because it can produce some quite extreme setups. So here's the first one. This is euro dollar and US non-farm payrolls some time ago. And just before the number, it always comes out, or typically comes out on the first Friday of every month. And just before the number came out, euro dollar was trading at 145.45.50, obviously a long time ago. And the number came out, it was much better than the market expected. So the knee-jerk reaction was to buy the US dollar and to sell the euro. So we saw euro dollar pretty much collapse from the news origin price, 145.5 or so, all the way down to 144.80, 85. So quite a sharp intraday movement. So we had this piece of news which surprised the market. So they sold the euro, they bought the dollar, the market as a whole, and the market collapsed. But what happened is, obviously, after the initial collapse, as I say, you tend to get this kind of reaction against the move, and then the market usually goes down some more. But in this case, what happened is the market started to trend a little bit higher. And before we knew it, we were all the way back up to the news origin point of 145.5. So what does that mean? Well, that means that anybody who sold this market on or after the news came out is now losing money. That's the whole point about the news trap. It's a market positioning trading setup. So when we got to the origin of 145.5, we knew that anybody who sold this market, all these people down here, were losing money, and which meant that basically the odds or the probability were that the market would not going to go down for the rest of the day. In fact, more likely the market should be going up, because positioning wise, these short sellers who are losing money will be covering their short positions, getting out to avoid further loss. So in this case, what happened for the rest of the session, euro dollar broke through the news origin price, came back and retested it. So former resistance became support in a typical technical move. And then the market continued to rally for the next few hours. So there was a trading opportunity there for the day trader for sure. So the market broke to the downside, retraced to the upside, break, retrace, and this is the buy trigger right here. So the market, after breaking above the buy trigger, started to trend higher. So quite a good opportunity there. It looks like euro dollar rallied a big figure, a whole 100 points or so from the news origin price. So certainly a trading opportunity there for the day trader. Okay, so moving on, another example. This one is sterling dollar, cable, and UK retail sales. So just prior to the number, cable was trading at 149.40.45 or so, the news origin point. And then the number hit the market and we had stronger than expected UK retail sales. So what happened was, as you can see on the chart, cable spiked up from the news origin point and spiked up just above the psychological 150. That was a barrier at the time, spiked above 150 and then retraced quite sharply lower from there. So the buyers came in on the stronger than expected number, pushed the market up, but there was no momentum to push it through the 150 handle. So the market sold off quite sharply. And then after the initial volatility, buyers came back in again and they tried to push the market up. They pushed the market up a little bit, but there was no momentum again to push the market much anywhere, in fact, anywhere near the 150 handle. So these people who bought the market up here were really trapped. These people were trapped as the market went higher and then started to break down. So later on during the session, the market breaks down and then breaks all the way back through this news origin point, 149.40 to 45. So again, as with the other example, the buy example on euro dollar, you can see that anybody at this point, once we break back through the news origin point, anybody who bought cable above the red line, the news origin point, on the back of the strong UK retail sales numbers, they are now losing money. So again, from a positioning standpoint, all the buyers are underwater. There's only one way for this market, really, in all likelihood, to go. And that's down. So what happened for the rest of the session? So after the initial chop, chop, chop around the news origin level, cable started to break down. So started to trend down a little bit there. Again, had a retest as old support became resistance, typical technical analysis theory there, breaks down through the origin, retests it. So this is like the last chance for the buyers to get out anywhere near their entry point. And then it meets fresh selling. Why? Because all of these people want to get out of the market to reduce their losses. So then the market starts to break down and trend lower for the rest of the session, closing pretty much just off of the day's lows. So again, another opportunity for the sellers on an intraday basis. The information that we have based upon the news trap situation tells you that the market in all likelihood wants to go one way, and that is the opposite direction to that of the breakout. Okay, another example here, more retail sales, this time from Canada. And what we had here was dollar Canada trading at a price of 101.60 to 65 just before Canadian retail sales came out. So again, strong retail sales. The Canadian retail sales figure was much stronger than the market had expected. It's amazing how often the market gets these numbers wrong. So that resulted in a big gap to the downside for dollar Canada. So in other words, traders sold the US dollar and bought the Canadian dollar because the Canadian retail sales figures were stronger than expected. So after the initial gap down, there was some selling, but again, over the course of the next few hours, there was a rally which took the market all the way back up to the news origin point. Okay, so the market went back to the news origin point, broke through it, came back down, through it, back down, and effectively settled around the news origin point. So going into the close of this day and the open of the next day, the Asian session, you can see that all of the sellers, based upon the news, the stronger Canadian retail sales, all of these people who sold the dollar and bought the Canadian dollar, at this point are still losing money. So this provided a bit of a floor for the market as it rallied, made higher highs and higher lows over the next few sessions. So that piece of information, again, I think was very valuable from the short-term trading perspective. Perhaps not so much instant gratification as we saw in the other markets, but certainly it provided the conditions for the market to turn around and to start trending in the opposite direction to the break based on the news, because all of the sellers were out of the market. They were trapped. So again, as the market starts to come back down towards the news origin price, buyers come back in on these occasions here. And again, these are the people who sold the market here using the dips to get out of losing short positions. Okay, here's a more extreme example of the news trap. Now, not all news traps form on one day, on the same day. Some of them take a few days to form and they can last for a few days afterwards. And that was the case on this example here. So at the back end of 2019, the Conservatives, Boris Johnson in the UK, won a crushing election victory over Labour. And that had positive implications that Brexit, with all the uncertainty about Brexit, having the Conservatives come in, they were going to basically deal with Brexit, and there was going to be a piece of uncertainty taken from the market. So good news, apparently, for sterling. So when we had the exit poll come out, I think just about 10 o'clock in the evening, we had the news that the Conservatives had pretty much won by a landslide. So the market gapped significantly higher from 131.75, the news origin point, right up to touching 135 handle. So quite an extreme move based upon the crushing election victory of the Conservative Party. So after the initial euphoric run up here, or gap up, bit of a retest of the high, then some profit taking come in, and then by the end of the next session, the market actually closed quite weak. So on balance, the buyers were underwater. Those that bought based upon the news were actually losing. They were underwater. So what happened over the next few days? So the next day after, we had a sideways move, and then we started to see some bailing out, some big selling coming in. And then the market broke all the way back down through that news origin point, forming the bearish news trap, and a big one at that. So there's the origin, there's the push, the break, and this is the retrace. So this tells you that all of the buyers are trapped. They're all the buyers, or anyone who bought on the strength of the election victory, are now losing money. And that's obviously what put a cap on the market for the next several sessions. In fact, it took, I think, weeks, months before cable went anywhere near 135 after that. So this particular news trap had really long-term implications. Okay, another example, again, this one on a multi-day basis. This is euro dollar, and yet again, US non-farm payroll. So euro dollar prior to non-farm payroll, in this case, was trading at 131.75. The number saw a decline in created jobs twice as much as the market had expected. And that resulted in the knee-jerk reaction to sell the dollar and to buy the euro, resulting in euro dollar ramping up aggressively over 2.5 hours. So really aggressive move to the upside here. obviously the figure really surprised the market. So the big boys came in, they started buying into this market like crazy. And by the end of the session, euro dollar, it was off the highs, but it was still well above the news origin point. So for the most part, most of the buyers, I would say, were quite content at the end of the trading session. So going into Monday, the market went sideways and then started to decline, a bit like the sterling example before. Then on the Tuesday, following the non-farm payroll, we broke through the news origin point at 130.175. So again, all of the buyers based on this news, this bad bearish piece of news for the dollar, for the USA, they were all the buyers were now losing money. And again, that is the whole point of the news trap setup. It's to identify a point where there has been a significant move based upon a piece of news coming into the market, but that move being completely reversed and retraced. And again, that's the case here. So once euro dollar got back below 130.175, we knew that the news trap had been formed and that the market should, in all likelihood, be going lower. And what happened for the next several sessions is the market went lower. 1, 2, 3, 4 sessions, 4 daily sessions to the downside. So quite a big flushing out. So again, the information that a significant amount of people were trapped based upon the hook of the bearish non-farm payroll number gave you a good directional bias for the next few sessions. Okay, a few more examples. This one again, non-farm payroll, euro dollar. You'll notice I use that quite a bit because it is quite extreme. This one was back in January 2019. And I just provided some numbers here just to help you get your head around the some of the numbers to watch for tomorrow. So the expectation for non-farm payrolls on this day was for a rise of 176,000 non-farm payroll jobs. So creating 176,000 jobs for the month of December. But what actually happened, as I say, this number is quite volatile and very often comes out way different from the expectation. What happened this time was the actual number was a creation of 312,000 jobs. So significantly above the expectation of 176,000 jobs. So again, the knee-jerk reaction here, euro dollar, by the way, was trading at 114.03 just before the number. So the knee-jerk reaction, again, was to sell the euro and to buy the dollar because the dollar was, the news came out strong for the US economy, that they created more jobs than the market had expected. So people adjusted, the traders, the big traders were adjusting their positions to the new reality of a stronger US economy. So big knee-jerk sell-off, the break, and then a bit of a bounce, retrace, and then a bit more selling all the way down. So going into the European session close, everybody, all the sellers were pretty happy because we were seeing quite a weak closing to Europe. But that's not the end of the story because foreign exchange is a 24-hour market. So what happened shortly around the European close was we had a bit of a short covering rally here. So the market they started to buy back their short positions. And before you knew it, we were back above that news origin point. And again, we are trapping all of these sellers that sold the market on the stronger than expected non-farm payroll. At this point, are now losing money. It's a bit like looking around the next corner to see what could happen and waiting for it. So essentially, you're waiting for the number to come out. You're waiting for the reaction. In this case, the reaction was quite sharp to the downside. And now you're doing nothing. You're waiting to see whether the market comes back to the news origin point. And if it does, then you've got yourself a trading signal or a bias. I've included on this chart in green the news origin point and the low for the swing. In other words, the end of the break move. I've also included the ATR, which is the average true range, and that's a measure of volatility which I use to determine whether the move is significant or not. In this case, the ATR was basically 85 pips. So at this time, on this day, the average daily range for euro dollar was 85 pips. It's a little bit lower today, but over this period, it was 85 pips. So this move from 114.03 to 113.45 came in at 68.2% of the average true range. That's quite a big move. That's quite a big intraday move. In fact, I like to look for the market to move at least 50% of the ATR to give me a good clue that a significant amount of players have committed themselves to the market. So in this case, we had a 68.2% ATR move from the news origin point. So we're back up now above it. We've formed the trap, break and retrace. Then into the close, market is just going sideways. Don't forget, we've got all of these trap sellers here. And then on the Monday, following the Friday, the market starts to creep higher, trend higher. So higher highs and higher lows. And for the most part, that is these sellers who are short and on the wrong side of the market getting out of their losing short positions. Okay, another example, same again, almost a mirror image, I guess. So 6th of December 2019, the expectation for non-farm payroll was for a rise, job creation of 187,000. The number came in at plus 266, again, much stronger than the consensus forecast for the number. So again, as in the previous example, we saw a knee-jerk reaction to sell the euro and to buy the dollar. So trading just below 111, we saw this sharp move down on the figure. So again, this is the big players coming in and selling the hell out of the market because the news is much better than expected for the US. Reaction higher, more selling pressure, and then it starts to trend lower. And again, as with the previous example, towards the end of the European session, still quite weak. But again, it's not the end of the story. The European close is never the end of the story. So in this case, what happened was on the Monday, which followed, the market went sideways and then started to move higher. So we're seeing a move against the non-farm payroll move to the downside, bit of a pullback, and essentially an inside session. So no real directional bias, except for the fact that the market retraced quite a big amount of the break move. Going back to the significance of the move, 110.97 down to 110.41, the ATR on this day was down as low as 37.7 pips. So this was 148% of the ATR. So a really, really big move, according to the gauge of market volatility. So on the next day, we came back up and we kind of just nibbled at the news origin point. Then the day after, pulled back and then broke through convincingly towards the end of this day. And that completed the news trap to the downside, a bullish setup. Then the market starts to accelerate higher at the end of this session. Next session sideways, following session gaps higher. And this is the trapped sellers based on the news trap bailing out of losing short positions. Okay, moving across to the Eurozone now. Here's an example of the ECB monetary policy meeting, which it holds every month or two. And during the meeting, it basically comes out with an interest rate decision, followed by 3/4 of an hour later, a meeting with the head of the ECB. And during this period, this is when we start to see some interesting moves as the market responds, first of all, to the interest rate decision and any policy changes they may implement, and then later to any changes in policy or slight inflections in the policy, according to what is being said by the head of the European Central Bank. So what we had on this occasion was just before the number, or just before the announcement, euro dollar was trading at 108.84. Okay, so 108.84. So then the market starts to trend lower over the course of the speech. We have a bit of a bounce higher, and then we see this big sell-off later on as the speech is coming out with bearish innotations. So we have a situation where we've got a fundamental event, a major head of a major central bank talking about monetary policy, and a big move to the downside. But over the course of the speech, the move is completely retraced. So we get the push back up through the news origin. And then in this case, we see instant gratification for the buyers. The market then starts to accelerate sharply to the upside after completing the trap to the downside. So the trapped sellers, based upon the bearish speech, are now losing money at this point. And this is a buy indication, which instantly saw a big move to the upside. Bit of profit taking for the shorts, for the longs, sideways into the close, and then the next day the market starts to trend higher, breaking above the 110 handle. So again, another piece of information which can help you on a day trade basis or on a multi-day trade basis. Okay, so there are a number of examples, and there are many more. But I think you get the picture from the examples. So now let's talk about how does one trade based upon the news trap setup. So the first thing that we do if we're trading based on news is we need to know what's coming out. And to do that, we look at the CFI economic calendar, which I showed you before. So we will know for the day ahead, if we're trading, which markets we're trading. We'll know which economic data is coming out for the countries which could be affecting the markets that we're trading. So if something comes out for one of the Eurozone countries, then France, for example, or Italy, then there could be a big effect on the euro. So it's just a question of knowing your market and knowing which pieces of data may affect it. Okay, so we check the economic calendar for impending news releases. And once the news, just before the news is released that we are monitoring, all we do is we mark on a piece of paper or on the chart the price of the market that we are thinking about trading. And this is the news origin price. So we draw our red line on the chart. Then we wait for a significant decline for a buy setup after the news. So we're waiting for this piece of news to come out. And if it's bearish and people suddenly sell this market, the market that we're monitoring, then we have a situation where we could be getting ready to buy it once we get break and retrace to the upside. So what are we watching for? A significant decline, which is defined as a new session low and or 50% ATR move below the news origin price. I like to include breaking a new session low to give it a bit more impetus. But more often than not, if you do get a 50% ATR move, you're going to be making new session lows more often than not anyway. Okay, so let's assume that we get the break to the downside. We break, we get a move of at least 50% of the ATR below the news origin point. Okay, then we want to place a stop to buy the market at the news origin price. That's going to be our trigger, the trigger level, the entry point for our long trade if we get to the point. If we don't get to the point, there is no trade. Okay, so this is essentially what the buy setup looks like. So we start off just before the piece of news comes out. The piece of news comes out, it's a bearish piece of news, and there is a knee-jerk reaction to sell the market. The market goes down sharply, and once it breaks down to the significant point, 50% ATR or more, then we are placing our stop to buy the market if and only if we get to the news origin point. Okay, so that's the setup. The break to the downside on a piece of bearish news. If we get to the news origin point, we're going to go long. Okay, so if we're going to go long, we need to know where we protect ourselves if the trade goes wrong. because not every trade is going to go right. Not every setup is going to be a winning setup, but we need to make a plan. When we're trading, we need to plan how we get out of this trade if we go right, how we get out of this trade if it goes wrong. And the stop loss for me is that the best place to put a stop loss is usually below the lowest point of the move you're looking at. So in this case, the bottom of the break move, the break to the downside, there's the retrace to the upside, stop loss just below the low of the break move. In other words, the swing low, the lowest point the market went to after the piece of news came out. So that's where we're going to put the stop. We buy here and we put a stop loss here. Okay. Now, I always say to enter, if you can, in unit sizes which you can divide by 3, because the objective is to get out not at one place, but to get out at 3 different places if possible. Because if we go long the market, we put a stop here, we don't know exactly where the market's going to go to. We haven't got a crystal ball. So I think the best way to handle this is to take partial profits at predetermined levels as the market goes in your direction, because sometimes the market will hit the trigger and it will break up. It'll go to this point, which I've called PT1, and then it will come all the way back down again. But what we don't want to do is just grab our profits at PT1, because there's plenty more opportunity to go for higher targets. So the way I do it is I typically say, okay, I'm going to buy 3 units. I'll put my stop there for all of the 3 units, but I'll sell 1 unit there, 1 unit there, and 1 unit there. So that's the plan. We need to have a plan for the trade. Okay, so how do we manage the trade? Well, we go long, if all goes well, we get the break to the downside and we get the retrace to the upside where we buy our 3 units. We put our stop loss below the lowest point seen after the news move. And then we have our target 1, target 2, target 3. So we're long 3 units here. If we get to target 1, we sell 1 of those 3 units. So we're now left with 2 units. So we've taken profits on 1 of the 3 units. In other words, 33.3% of our position. Now what we do is we move our stop loss from the risk point to the entry point, which means that if the market falls from PT1 back down to the news origin point here, we then exit the rest of our position at break even. So it doesn't cost us any money. So all we've done is we've made a small amount of profit on the first unit of the position. But if all goes well and the market continues to go higher, hits PT2, we then sell another 1 of our units. So we've gone from 3 here to 2 here and to 1 here. So we sell our second unit, we've got 1 unit left, and then we move the stop up again from the entry point up to PT1. So this means that we've locked in some more profits on the rest of our position. So if the market falls from PT2 to PT1, we get out of our position, banking profits on the second unit of this amount. And then hopefully if the trade goes as we plan, we hit PT3, the third target, and we say thanks very much. And then we walk away and wait for the next opportunity. Now, I guess the question could be PT levels, what are they based upon? Well, I base them on the volatility measure, for example, ATR. I mentioned average true range for the impact moves. I like to use ATR as my input for determining where my stock will be, because it's based on market volatility, which changes every day. So if the market suddenly becomes volatile, our stop loss should be further away from the price because there is more noise in the market. Another way to do it would be to do multiples of the stop size. So if the stop is 50 pips, you may have a first target at say 50 pips and a second target of say 100 pips, and maybe a third target of 150 or 200 pips. So depends on your own preference, I would say. I also like to use what I call a time-based stop. So what do I mean by time-based stop? So basically you enter into a trade. How long is that trade good for? Do you hold the trade forever until you get stopped out or until you hit your target? Or is there some intervening time point where you get out before momentum can change? Because let's face it, what we're talking about here is momentum-based trading. We are buying when the market is going up, and we are joining the buyers as the market is going up. And we're looking to get out before the market suddenly turns around and goes in the opposite direction. So we need, as well as price targets, we need a time target. In other words, when do we get out of the trade in terms of how many days, how many hours, how many bars, whatever it is you're using on your on the chart that you're analyzing. The main thing is that we are capturing as much of the profits as we can as the market goes in our favor, and reducing the risk as we go along by moving the stop in the direction of our position. Okay, so that's the buy setup. So the sell setup is basically the same thing, but in reverse. So to trade the news trap sell, what do we do? So again, just before the news is released, we note the price of the market or markets that we may well be trading based upon the news trap. And that price will be termed as the news origin price. So we're waiting for a significant rally after, based upon the news. We want a bullish piece of news to come out, just like those UK and Canadian retail sales, to come out and to see a big move to the upside as people come in and they react to the new reality of a stronger than expected number. Okay, impact-wise, we want to see a new session high and or 50% of the average true range above the news origin price. If we see that, then we're pretty confident that we've seen enough people come into the market based on the news. And these are the people that we'll be relying on to be causing the selling pressure if the market starts to retrace. Okay, so we see the break to the upside. And once we see the break to the upside, we put our order to sell 3 units at the news origin price. So again, if that price comes all the way back down to the price it was before the bullish piece of news came out, we want to go short. Okay, so this is what the setup looks like. So before the news comes out, we have the news origin price. This is the price that we are at just before the piece of news comes out. So again, let's say the piece of news comes out, it's much better than the market expected, and suddenly everybody's buying the market. So the market ramps up like this. Just imagine a bit like that UK retail sales number. The market gets sees this big ramp up here, and then after that initial buying, it meets some selling pressure, and then the market starts to come and retrace all the way back down. And as soon as we get back down to this news origin point, we are going short 3 units because we have seen the formation of a bearish trap. Okay, where do we put our stop loss? Again, the best place to put the stop loss is above the highest point seen after the news came out. So that's the swing high, the end of the break move. So that's where the stop is. Profit targets, again, we need to have places where we know in the future, if the market goes as we expect it to go, we'll be taking profits here, here, and here. How do we manage the trade? Same way as we did for the long position. If we are lucky enough that the market, after filling us in 3 units short, hits our first target, we buy one of those units back. So we were short 3 units, we bought one back at this point, PT1. Now we're short 2 units, and very importantly, we've lowered our stop loss from the risk level, in other words, the level at which we'd lose some money, to break even, the level at which we do not lose any money. So we've taken profits on 1 out of 3 units here, and we've reduced our risk to, from this point, 0. So we're quite happy on this trade. Now, we're hoping that the market will continue to go down, hit our second target, where we buy back 1 more unit, lower the stop to PT1. And if all goes well, we hit PT3 and we get out and we say, thanks very much, very good trade. Or the time exit, which kicks in and says, okay, just get me out of the trade. Now, just as a matter of interest, I've used non-farm payrolls quite a bit. I've noticed that non-farm payrolls always come out on Friday. I've noticed that if you get into a news trap based on non-farm payrolls, if you get in on a Friday, typically Wednesday or Thursday is a good day to get out. So these setups are usually quite good for 2 or 3 days, I would say. Okay, again, just to reiterate, profit target levels can be based on multiples of your stop size, your initial trade risk, or multiples of a volatility measure such as ATR, average true range, or price bands. Again, good to emphasize the fact that I use time-based stops to get me out after so many bars. So in the hypothetical case, I guess, of a non-farm payroll on a Friday, get in on the Friday and get out on the close of Wednesday, the following Wednesday. That would be an example of a time-based stop. So you're not doing it based on whether you're in profit or loss. You're doing it based on whether a certain amount of time has elapsed in the position. Okay. Okay, so just to summarize on the news trap, news traps can form at any time. So news traps are basically, as I say, they break down into scheduled and unscheduled. So most of the time, we'll know which news events to look for. We'll know where the origin price is quite easily. We know these things. We know the releases in advance. But the unscheduled pieces of news are the ones that we need to watch out for. For example, back when Donald Trump was in charge, he used to tweet quite a lot in the middle of the night. And there were quite a lot of news trap examples based on Trump's tweets. He might be tweeting about China or COVID or something like that. And we get a sharp move in the S&P, which when it gets completely retraced the next day or the next 2 days, that gives us a news trap set up based on an unscheduled piece of news. And the same thing can happen for anybody, any politician or monetary official who can influence the markets one way or the other. So once a news trap is complete, as I've shown you, they can often see follow-through action which can literally occur over the next few hours, or sometimes they can last for several days or several weeks or even several months. In the case of the UK election bearish setup. So the news trap based on the UK Conservative election, that provided a trading opportunity for a very long period of time. So with regards to going into a major news release like non-farm payrolls or like an interest rate decision or GDP or any of the big pieces of economic data, rather than and this kind of works particularly if you're a short-term trader, rather than enter a trade just before the news release or be positioned with a tight stop just before the news release, the disciplined trader could benefit from waiting for the trap to form before making a new trade. Also, another thing that might be a good idea if you happen to be a day trader and you're trading over non-farm payroll, for example, it might be a good idea to close your position or take protective measures like hedging it up, because when the volatility kicks in, when the number comes out, you could be taken out of your position before the market goes in the direction you want it to go. So it's good to be a little bit cognizant of the fact that there is a market impact piece of data coming, and rather than take a new trade before it, why not wait until after that piece of news comes out for the trap, which gives you a good reward risk probability type trade going forward. So news trap is valid on all markets which react to news events. So I would say to keep an eye, if you do happen to be a discretionary news trader, to keep an eye on your economic calendar, watch out for the current day's events, mark events which caused significant moves over the past few days on your chart, so that you know that if you cross over one of those thresholds, you know that you've got yourself a setup. Whether you take it as a trade or not, that's not necessarily relevant. You could take a news trap setup as a trade, or you could use it as a piece of information which can help you make a decision as to which way a trade is likely to be, long or short. Okay, so that's pretty much the news trap. Now, just a few words on money management before I close for the week. On every trade, I would say very important to keep your trade risk constant. In other words, don't vary your size too much on each trade. The risk is it's much better to keep the risk as small as you can, because obviously one bad trade, if you're risking 5–10% of your equity, can cause quite a bit of damage. So you need to think a bit like a professional in terms of how much capital you risk on any one trade. Most professional traders will be risking less than 1% of their capital on one trade, but up to 2% is not necessarily too catastrophic a lot of the time. It just depends on your risk tolerance levels. The main thing is it's got to be comfortable for yourself, and it's got to be not too big a number that if you do have a series of losing trades, which everybody does, it's not going to be too catastrophic in terms of financial and also psychology. That's one part of trading that a lot of people miss out on, the fact that trading is very much a psychological game. So if you take a hit on a trade, which you will on many occasions, as we all do, make sure that it's not going to make you lose any sleep at night. Even the best traders or systems, they suffer drawdown periods, a series of losing trades. So if you're trading, treat it like a business. Allow for a drawdown period as part of your trading plan. And I would say in closing, the best thing to do is to be patient and to wait for these traps to form, because they will form on a regular basis. It's a regular feature of every market that big moves form after the formation of traps. So wait for the trap to form. That gives you a clue which way the market should be going, and then take action. Okay, so that pretty much sums up the presentation. Do we have any questions on the content for the day? No open questions at the moment. I know there are quite a lot of concepts in there that may be unfamiliar to some of you. Be very happy to field any questions, perhaps during the week. If you go through the PowerPoints and there's something that you don't understand, be very happy to explain further by email. Obviously, if you have any questions, please feel free to talk to your CFI representative. They will pass on any questions to me about any of the content. As I say, tomorrow is the non-farm payroll release for this month, covering the data for February. So 2:30 Central European Time, 1:30 UK time. So watch out for a significant move based on the non-farm payroll number deviating significantly from the consensus forecast. Tomorrow could be a very interesting day. Okay, so there we go. I think we have. Okay, perfect. So if there are no further questions, thank you very much. It's been a pleasure presenting. I'll be back same time next week. So I look forward to presenting again same time next week. I wish you all the best and happy trading.